Okay, so hello everyone. First of all, thank you so much for taking the time out from your busy schedule and joining in. It's a very special day because we have someone very special from ASK Investment Manager. So we thought we'll organize this session, and at Allport, our idea is to organize these knowledge-based sessions and educate and empower the investor community as a whole. And I've been requesting George to take out some time and let me apologize that last time we couldn't make it because he was not keeping well. So let me first introduce George, and then probably we'll start the session. So, it is my privilege to welcome George here. George brings about more than 2 decades of rich experience when it comes to investing, having led a couple of large organizations and their investment team like ICIC and ITI. George moved on to BlackRock, Geo BlackRock AMC, spent some time and then took over this profile as Chief Investment Officer at ASK Investment Managers. Well, ASK doesn't need any kind of introduction, but there are some NRIs who have joined in here. So, for their benefit, ASK has been into AIFs and PMS business for over 2.5 decades now. And ever since they've started, they bring about most consistent track record of delivering the deliverables. And one of the old strategy which has been into existence is from 2002 onwards. So they were the early one to get the license during 2002 times, and then started PMS business. So PMS AIF, both put together, one of the largest portfolio managers in India and most respected house, as far as my experience with the brand is concerned. So let me hand it over to George. George, over to you, and thank you so much for accepting our request and taking the time out. Thank you.
Yeah, thanks, Vikas. It is a pleasure interacting with each one of you. And I have, briefly, I want to touch upon what I have gone through in the last few decades, in terms of investing. So thanks to my dad, got introduced to stock markets in the year 1990, and 1991 onwards, I'm behind markets. And he gave me some money in 1991, and just before the Harshad Mehta scam breaking out. 1991 is when Manmohan Singh came with his dream budget. So I am live in the market since then. 1992, just before the Harshad Mehta scam, I started investing in my dad's account. And the first investment itself went through the drain, which became one fourth in no time, in 5 months. That is where I realized that it is not easy to make money. And the starting point was my father bought a bunch of investment books on my birthday in 1990, which eventually helped me to build my knowledge base and also become a passion. Today, as we speak, when I come to ASK on a daily basis, or when I've been working all through the professional journey in the last 25 years, every day I felt like I'm walking into my office to follow my passion, and somebody is paying me for that. So that is
Wow,
the
lovely put down.
that is the nature of my job, fortunately. Uh, have tracked markets very closely for the last 34 years, as I mentioned, and especially in the last 25 years in the investment management, as a corporate treasury profile I started, and then eventually more into investment management role. Worked with a lot of MNCs, initially MetLife, Deutsche Asset Management, Merrill, and the longest stint was with ICICI Prudential Mutual Fund, where I spent time in setting up the processes for the asset management company to build the conviction for the research analyst and management team to pick stocks at the right fashion and create a processes around it. So way back in 2008, the size of the AUM for the firm was very small. So putting the processes were important. And 2008, the Lehman crisis happened. So lot of learnings we had, and we put alongside, we build the processes and frameworks in investing, and eventually that has helped the firm to scale up. So I've seen the scale up from 13,000 crore equity AUM to 3 lakh crore equity AUM. So all those things was visible very vividly in memory. Last 6 years specifically, I was in the entrepreneurial mode. Worked as a CEO for a startup AMC ITA mutual fund, and built it from scratch to from zero to almost $2 billion in assets, and also building a team of from zero to 300 employees and 30 odd branches and so on and so forth. So that was a pure entrepreneurial journey working with the Sun Pharma promoters. And last 2 years specifically working with Mr. Ambani's office, working very closely with Mr. Mukesh Ambani and Manoj Modi sir, and also KV Kamath sir, and who started ICICI Bank, and I was reporting into him, and built the Geo BlackRock JV in India, and also so I come with a variety of experience in terms of building businesses as well as managing money, and also passionately following stocks as well as different asset classes. What I learned over the last 34 years is something which I want to talk about initially, and for
Sure.
which I have a couple of slides, which I can I share that?
Yes, yes, please. And once that is over, then we'd like to hear from you in terms of, is there any changes that you're bringing as far as the ASK investment team is
Yeah,
concerned?
so that then is inclusive of that actually. What I'm saying is
Great, great.
it's a part and parcel of what we have implemented at ASK. So how do I share? Yeah, I can see that.
Yeah, just go to share and present the screen.
Can you see my screen right now?
Yes, yes, very much visible. Over to
Oh,
you.
okay, okay, sure. So let me take you through the slides. So what I'll straight away jump into one of the most important. Yeah. So can you see a chart? Can you see the chart on the screen?
Yeah, it is yet to come.
It is yet to come. Is it visible or no?
Uh, I can see proud to be recognized for building a workplace that reflects what matters the most. That's the first slide.
No. Okay. Still, it is on the first slide. Okay. Sorry. Um, is it changing or is the chart is visible?
One second, I'm just checking in another computer. One second. Okay. No, they also can't see. The audience also can't see the. We'll have to again reshare, I guess.
Okay. Sure. Um, I'm sorry
Because
for.
if no, no problem. If the first page is visible, yeah. Yes.
So this is a there is a chart, right? Hello.
Chart is there. Absolutely.
Yeah. So
Perfect.
this
Now
is
we
a
can see the entire.
yeah.
Yeah.
So the Sensex chart for the last 30 years. So if you see 1991, this is a period where economic liberalization started with Manmohan Singh coming in. What this chart is talking about is 34 years how the market has behaved. The first 10 years, you saw the market, especially the technology, media, telecom stocks doing very well. So that's called a TMT rally, and which was like 19 times the stocks have moved up, and it's a global rally which happened. And so in this decade, if you are not in technology stocks or media stocks or telecom stocks, you are not making money. Hello?
Yeah, I can hear you. Please continue. I can see the screen also.
Okay, sure. So the technology, media, telecom rally happened, and after that, the dot-com burst happened. Which is basically a big sell-off in US, and it also happened in India. And what you have to remember is that after every big sell-off or every big crash, like dot-com burst in 1999 and 92 in 2000, you saw massive recovery in different set of sectors. So every time when a crash happens, you have to remember the new set of sectors or new regime starts. And after dot-com burst, the sectors which performed are real estate, industrials, financials, and utilities and commodities. That continued for 10 years. So what worked in the previous 10 years stopped working after the crash. And then, it continued with a different set of sectors. And then, the global financial crisis happened in 2008. After the 2008 crash, what worked is, from 2008, there was monetary easing, big interest rate cuts, and all those things happened. So till 2010 November, the same set of sectors continued, but post that, there is almost 1 year more after the crash, the market continued 1.5 years more. In the similar set of sectors recovered because of the monetary easing, but post that, the industrial cycle collapsed and the growth globally collapsed, and therefore the next 10 years, the sectors which did well are consumer-led sectors, consumption-led sectors. Asian Paints. So previous decade, you saw when infra boom happened, commodities like DHL, in industrial capital goods sectors, commodities, all L&T, all these did very well. And this consumption-led growth period, this decade, you saw Asian Paints, Pidilite, and all these sectors doing as companies doing very well. And then the COVID crash happened, and post-COVID again, the sectors which are doing well are real estate, industrials, utilities, and financials. So PSU Bank financials. So if you look at after every crash, new set of sectors emerge and new business cycle emerge. This is what I call market cycles, and it coincides with different business cycles also kicking in. So if you are not mindful about these market cycles, every decade new sectors emerge. Every decade after a big crash, new sectors emerge. If you're not remembering this, you will miss a decade. We have seen the period like 2010 to 20, Asian Paints and all these kind of sectors, stocks doing very well, consumer-led businesses, distribution-led businesses,
True.
trend, Bajaj Finance and Bajaj, all these things. So this is something which you have to remember. The key summary is markets go through cycles, big 10-year decadal cycles, and the decadal shift to capture is something which a fund manager or as an asset, a wealth manager is supposed to do. Now, if you look at the kind of rally which has happened, Wipro from 6 paise in 1990, it went to 41 rupees. And 25 times multiple, price to earnings multiple went to 350 times. This is the first decade. Second decade is infra boom. BHEL from 10 rupees went to 310, 30 times. And the multiples also expanded. The next decade, consumer cyclicals or consumer rally. Bajaj Finance, which is a consumer financing company, it went from 3 rupees price to 530 rupees price, is 175 times. Right. So last 5 years, which sectors
Right.
did well? Metals did well. It became 6 times. Real estate 5 times, and utilities 3.7 times. So what I want to highlight is that ASK was in this yellow period, consumption-led growth. This is the period where ASK did exceedingly well, and this is where you saw big boom in the stocks of consumer-led businesses. So what we have done at ASK is that we have put the investment philosophy proper. What was good at ASK? ASK was always good at fundamentals of the companies, understanding the businesses, the balance sheet health, business quality, profitability, etc. Second, understanding the growth opportunity, the opportunity size, how scalable the business is, the industry structure, growth, etc. We were so FOI explained. I will skip C for the time being and straight away move to U. Unmatched modes. Basically, what is the competitive strength of the business, technology, brand, network effect, which was very good at ASK. S is margin of safety, which is basically buying things cheap. So probably there was a little bit more emphasis required on C and S, and that is what I have done since I came in 4 months back. We have put a lot of emphasis on cycles, and we have put a lot of emphasis on the margin of safety. Otherwise, in most of the other things which ASK was doing, cycles I already explained why the cycles are important. Decadal shift is important, and also which businesses perform. There are different sets of businesses perform at different points in time. Now, my view is the sectors which started performing well in 2021, those same set of sectors will start doing well going forward also. So it is a decadal shift. If you remember 2020, COVID happened. During that phase, the interest rate in US and inflation in US became zero. And it was a 40-year bear cycle in rates. In 1980, the interest rates in US was 18%, which came down to 0% in March 2020. And then the interest rates, when it started moving up, the sectors which are beneficiaries of the inflation started doing well. Commodities, real estate, industrials and utilities, and financials. So that is one of the reasons. If you see in the last 5 years, these set of sectors did very well. And the previous decade, FMCG, pharma and all were doing well, which became massive underperformers. So summary is, every decade will be very different. 2020 marked a very different decade. Interest rates are moving up in US and inflation is moving up. The situation in US is not very easy. You are in a situation where the de-dollarization is happening. People are moving away from dollar, and therefore IT, pharma, and FMCG to do well in this kind of environment where the FMCG is extremely overvalued, and IT and pharma are sectors which is not doing that. Pharma specifically, it is significantly overvalued also, according to me. Especially the global pharma businesses, especially US-facing businesses, and IT, for that matter, has its own challenges with the artificial intelligence as well as the dollar depreciation possibility. Last so many years, we have been only listening to last 40 years. If you see interest, we are talking about INR depreciating against US dollar. Depending upon the situation, how INR will behave is yet to be seen. But what I am very clear, or what is very important to note, is that US is in a very bad shape, and that is why Donald Trump is trying to increase the tariffs and so on and so forth, because the debt levels in US is significantly higher. So whenever the debt levels are higher in a country, and plus the fiscal deficit, which is like revenue minus expenditure per year, also is at obscene levels of 6%, and plus the trade deficits are at 6.9%. That's where you get the country get into trouble, and that is the situation where US is in. Therefore, Donald Trump is making a lot of noise to control or tame down the US dollar devaluation. But the debt levels, or when the country borrows so much, there is no other choice but to do something about it, and make sure that the country survives. So that is what they are trying to do. It is as good as a household borrowing on credit card, and how long you can live on credit card. At some point in time, the interest will be more than your principal, and you will be paying obscene interest. That is the situation at which US is in. So what we think at this point in time is there is a significant challenge that US will face as an economy, and that is what they're trying to bring down or tame down the expectations and trying to maneuver through, but it is not very easy. That is where probably we have to focus more on domestic oriented businesses which can do well, and also the inflation oriented business, because the US inflation is bound to go up as the tariffs increases and so on and so forth. So we have to buy into inflationary sectors which will do well when the inflation goes up. So we are in that mode. Now coming to the valuation, I just want to highlight, this is something which I look at on a regular basis to understand where to put money. Today, if you are giving me money today, where do I put? Whether I should put in a large cap company or mid cap company or a small cap company. This is a question everyone will have in their mind. And this is a very valid question. And this is one of the important questions the fund manager should ask themselves. When you look at from that perspective, the valuation of small cap was the lowest, the green colored bar you see, the lowest was in July 2013. Today, it is at 3.5 times. So 0.8 times to 3.5 times, 3.5 times you can see in the entire chart. Only in July 24, it was higher than that. Otherwise, there is no other period in which the interest rates, the valuation of small caps were so high. So whenever the valuation is high, you have to remember in investing, you have to buy things cheap. Whenever valuation is high, this is not the best time to invest into small caps. Or, again, mid cap, if you see July 2007 is the only period where mid caps were higher than this. There was a peak of markets. And, August 2025, if you look at it, is 4.2 times price to book. Lowest was again July 2013. Thankfully, or, to my thrill, I was in ICICI in July 2000. I was in ICICI from 2008 onwards. And July 2013, I had the opportunity to launch a small cap pipe portfolio, and we collected money at that point in time. So it was like a thrill for me, that absolute bottom of the market valuation when it was extremely attractive in small caps, I could collect money. But was it an easy time to put money into small cap? The answer is no, because everything what can go wrong has gone wrong. Interest rates were high, inflation was the highest, WPI, wholesale price index was 10%, and credit growth was the lowest, and taper tantrum was happening because US was cutting down the buying back the bonds. There was a lot of uncertainty. Modi ji was not elected as the prime minister, and Raghuram Rajan was not appointed as the RBI governor. That was the situation of July 2013. Green color looks very easy, but that was not the best time you feel like to put money into the markets. And that is a time where you get things cheap. And that is when I had the opportunity to launch a small cap by PMS. And eventually we were able to generate superior returns of 384%, and we were able to give back the money. So the currently the message I want to give clear is that this is not the best time to allocate money into mid and small. This is the time to allocate money into large cap oriented portfolios. Now coming to a fund manager, as a fund manager, the first thing I look at is that if I get money, and these all are implemented at ASK, whatever I am discussing is something which is implemented and we are practicing in the last 4 months. So the first decision making point for me is, if you give me 100 rupees, where do I put that money? That is called asset allocation, asset class allocation. So whether I should put in equity, whether I should put in debt, whether I should put in gold or real estate. Now that decision has to be thought through looking at the relative attractiveness in the different asset class. So that is the first decision making. Second decision making is, if I decide that I want to invest in equity, the second decision point is that I need to decide which market cap I have to bet, whether it's a large cap portfolio or large cap stocks or mid cap or small cap. That I explained just now prior to this slide. I explained why you should put in large caps. Then third decision making point is sector or themes. Which sectors I have to bet on or which themes to bet on. This is also very important because if you straight away go into the stock selection, you are not clear where you want to hunt for ideas. But if you know that which sector to look at, and this all can be done through analyzing the data points and the valuation and the return potential from that sector, and that is to be that is what we have implemented the first three quadrants: asset class allocation, market cap allocation, sector or theme allocation. We look at data, and that is a data driven decision making process or approach which we have implemented. The last quadrant is the stock selection. This is where the entire time of the analyst team and fund management team is spent, where to put money and which kind of stocks in. So once we identify that, okay, in large cap I need to invest, and then first I decided which asset class. I decided, okay, equity I want to invest. Second, I decide which market cap. I decide large cap. Third, I decide that I want to invest in cement, for example. Then I know that what stocks to pick in the cement sector. So that is how we approach the whole investing. Now coming to the investment management framework, this is basically how ASK look at companies and arrive at the bunch of stocks. This again we have implemented. We look at a bunch of macroeconomic parameters basically to look at where do we put our to understand the sectors, sector classification, asset class classification, market cap. That is the first priority. That is more of data driven approach. Second part is the fundamentals. We analyzed top 750 companies. 750th company is 3,000 crore market cap. So we decided top 750 companies we thoroughly analyze and decide, which we look at from the industry structure, governance, growth prospects, balance sheet, and profitability and moat. And which I explained earlier, all these things we have parameterized, and we look at it how these 750 companies stack up. And we realize that, and then we divide it into A grade companies, B grade companies, C grade, and D grade. And A, B, C becomes our hunting area, and D is not something which we would be liking to track. Out of 750, we realized there are only 492 stocks which we need to track on a regular basis. So for that, what we did is we increased the coverage, the team. We used to track approximately 250 stocks earlier. Now the number of stocks what we are covering is 500. The head of research has been hired. We have hired a head of research who has come on, Saurabh Patwa, who has come on board. He used to work with the HDFC Mutual Fund for 14 years. He's having more than 20 years of experience. He has come on board as a head of research. We have increased the research analyst bandwidth. From earlier, we used to have 7 analysts. Now we are having 10 analysts who are already on board. And also we are hiring another 5 more analysts. So, and plus the fund managers, currently we have 2 fund managers apart from Sandeep and Kuldeep. We have hired 2 more. So we have a bunch of very high quality resources looking at the portfolios. And that is something which we have done in the last 4 months. So during my gardening leave before joining, ensure that we have a team in place, and we have done the efforts. Now coming to product positioning, the existing products like IEP, growth, all these products, we have put into 5 clear risk buckets. Earlier, what used to be is, we used to have a lot of overlaps between portfolios. Now the overlaps have been completely, reduced significantly. So of them are large capish portfolio. As we speak, it is 100% large cap, 15 stocks portfolio. ASK Vision or DRP Edge or Golden Decade Fund, all these are large and mid cap. It's a 50% large and 50% mid cap kind of portfolio. IEP or growth are flexi cap. 60 to 100% always will be large cap, and balance will be in mid and small. But currently 73% of IEP is large cap and growth is upwards of 70%. Emerging opportunities portfolio is a mid cap portfolio predominantly, and mid and small. Currently almost 75%, 75 to 80% is mid and small, and conviction is again in mid and small. So emerging opportunities portfolio, ideally it's a mid cap portfolio, but currently the positioning is some sort of high quality, very high conviction small caps are also part of it, and which can be up to 30%, which is the leeway which you have taken in this portfolio. So net, what I want to say is, and then lighthouse is, these are all satellite ideas what we have: lighthouse, ASK special opportunities, and ASK financial opportunities. So core portfolios are these five, and the satellite portfolios are these three. So all of them, like lighthouse, for example, it's a thematic product, which is we are playing the manufacturing infra cap goods theme. If you remember the first business cycle slide which I explained, that is a segment which we are extremely bullish, and that's why the lighthouse portfolio as a thematic rotation portfolio which we have started, which we like a lot. ASK special opportunities portfolio is basically, you are going and buying good quality companies which are going through maybe a rough patch in the near term, but it is a temporary patch. So that is the nature of high quality, good credentials companies, proven track record, but going through, like HDFC Bank, for example. Last 5 years, the company has not done well because of the merger issues with HDFC Limited and so on and so forth. That becomes an opportunity for you to buy. Financial opportunities portfolio, it's a financial theme which you are playing. So all these products are very focused products. The difference in a PMS is that we will be having PMS or AIF is that we have a very concentrated portfolio, and that is a beauty at which we run. Now, what is the outlook today? We want to focus on domestic businesses, as I mentioned earlier. We like private banks, which is the lowest valuation segment today in the market. And we like healthcare companies, which is hospitals. We like cement companies, which is coming out of a lull period of growth, and plus the consolidation has happened in the sector with Ultratech and Adani being the leaders. Capital goods, which is again linked to infrastructure and manufacturing, which is again, we like the sector. Auto, with the GST cut and rural recovery is visible, and we like auto, like two-wheelers and rural recovery plays like Mahindra and Mahindra. Oil and gas companies we like, that is something which we like. Real estate, again, we like this segment because the sector is going through a complete upturn. And if you maybe 1 month, last month, because of the rains and everything, unseasonal rains, the real estate sales would have slowed down. But this is a sector which we are very bullish from the next 5-year perspective. Travel and hospitality, hotels we like a lot. That is something which we like. Chemicals and telecom, because telecom, Reliance, and again the consolidation has happened in the sector. Hospitality, even in the case of travel and hospitality, especially in the hotels, again consolidation plus the business model change. From a very capital intensive business, it has become low capital intensive business or asset light business. What we don't like per se, probably we might have a lesser, we might have lesser of exposure is IT, anything to do with the global USD focused businesses, auto, pharma, IT, which will be very careful. FMCG, because the valuations are rich, still we don't see any opportunity there, which has been the case from 2010 to 20. It got extended, therefore the valuations are obscene. Now it has corrected a little bit, but it's still not attractive enough. And metals and mining, mainly because it is a China play, and if and there is no value addition per se in metal companies, we can see it's predominantly a commodity rally. If it happens, you have to buy those stocks, which we generally try to avoid. We want to buy some businesses which actually has a good moat, good advantage, or good product. So those we are consumer durables. The sector has done very badly. So there is a case to look at it, and we are actually looking at it. So what I want to highlight is that at a team level, we are extremely focused on these businesses, and we are put a structure to ASK. Since I came on board, we have put certain structure to ASK, how we manage money, how the fund management business will work, and also we have ensured that there is a clear case in which we look at the different businesses and arrive at the portfolio. So net, the portfolios have been well defined, and we have restructured the portfolio in the last 4 months, which was very much required to ensure that the portfolios start functioning the way it should be functioning. So I'm extremely confident today when I'm talking to you guys that portfolios are in a much realigned good process, and this is something which we have done over the last 3-4 months. So I head the investment platform for ASK and ensure that we have a very good structure in fund management. I look at the PMS, offshore, alternate investment funds, and also the upcoming mutual fund. So that is the broad, thought process which I want to share. So what is important for the team to know is, we have a great team. I was, browsing through the slides to
Sure,
ensure that
sure.
you understand. We have a great team,
Yeah,
and
yeah. For
we
our
are
audience.
quite bullish on India, and we believe that the money will, foreign institutions, whatever the chaos you are seeing, be it a tariff war and so on and so forth, ultimately India will do very well, and this is one of the emerging economies, and you will see India getting more attraction from the global standpoint, be it the financialization opportunity, capital market theme looking very good, defense opportunity, digitalization, stable government and reforms, and institutional strength and governance and favorable demography. So all are added advantage to the our business model, country's business model, the country's economic model, and we believe that that is a value proposition which we want to position ourselves very well in this kind of environment with our combined investment experience of more than 150 years and 40 years of legacy of ASK. So I'll stop here and take questions if you have any.
Sure. No, thank you so much for enlightening us with a detailed
I've asked.
presentation. My first question to you, George, is that how important it is for you to book the profits at the regular intervals. For example, Bajaj Finance is doing well, but there will be a possibility that it can go through its own consolidation time. So, do you think it is important to book profits at the regular intervals, according to you?
Not very regular intervals, but we have to take with its own stride. There are periods where the segment of the market or the sector stop functioning, right? And there will, for every company, that will be there for in their longest journey. None of the company would have been able to continuously perform for, say, for example, in the journey from a small cap to mid cap or a mid cap to large cap. The company would have undergone consolidation phase multiple times in the period of say 20-30 year journey. So if you are a long-term investor, you have to be patient enough. At some point in time, if you like the business thoroughly, and if you know that the business is strong enough to compound at a long-term growth rate, and this is not a company stock, which I want to get rid of my from portfolio from a long-term perspective, then you should have the patience to hold on to it and compound it in your portfolio. But nevertheless, valuation is very important. At some point in time the valuation is not making sense, then you should trim down the exposure and move to something better. But most of the time, the good part about ASK is we take a little bit long-term call and we hold on to it, and we enjoy the compounding part significantly. So if an investor coming to ASK, if he holds the portfolio for long term, he will be a very happy person. The problem is, people come in and think that it's a fly by night. Quickly in next 1 year, 2 years, you want to make all the returns. It doesn't work that way. So you need to be patient now. And equity as an asset class per se, you need to have 5 years window, right? Otherwise, you should not get into equities. That is my view. If you have 5 year plus window, then you should invest in equities. And today's market situation where valuations are stressed for mid and small cap, the same problem can happen. People who have come in the last 5 years, their expectations are very different, because 2020 to 25, every sub gade gode sub chala, right? So the problem is, people think that that is a return that you will get in the next 5 years. The answer is no. The return will be function of your ability to pick the right set of sector stocks in the next 3 to 4 years. And to my mind, that is far and few today. When I meet my clients, many of my clients say that, George, we have made a good return in the last 5 years, and your portfolio has done badly, or this is not the time. I'm thinking that PMS is not. So today is a time where fund managers and advisors will have less value, and the time will come, in a year or so, 2 years or so. Yeah, I think in a year's time, you will see that people will chase fund managers and advisors, because people will have a tough time handling their portfolios, because mid and small cap space has done very well, irrespective of whether it's a quality, whether it is a good company, bad company, everything has done well, right? So we are very cautious about what we buy. And when we do that, and when we are sensible, there are period of time, we have to give away some, outperformance. We need to underperform at certain peak market situation to perform later, right? And not to lose your shirt, right? So that is something which is very important at ASK, and we will be careful about our clients' money. We'll ensure that we manage the money very effectively, and we don't run behind third grade companies to optimize the returns.
Sure, sure. Do you think, George, uh, would you be ever considering, maybe not now, 1 year, 2 years down the line, taking some amount of cash call as a port PMS manager, unlike a mutual fund manager? I mean, just question on behalf of some of our investors.
That is a continuous debate. The day I joined, I presented to the investment committee saying that this is a time to take a big cash call. Okay. And, because especially in the mid and small cap space, large cap, I can see money making opportunity. Large companies, some of them are extremely cheap, and, 5 year low, I am able to get. Then, that is the time to bet on those large names. But especially in the mid and small, as I shown the chart, the category valuations are very high. And that is a point where, especially the mid and small cap money, whatever I'm managing, I wish I could take a cash call. And, that is something which we are contemplating. But the thing is that it cannot be an ad hoc basis. It has to be methodical, data-driven decision-making basis, which I have already presented to the investment committee. And, if the approval comes in, probably at appropriate time, if as per the internal framework what we have set, we will be able to take the cash call at that point. Right now, the approval is not there to create those kind of cash calls, because invariably in India, market has been only going up, right? And therefore, any cash call at any different points in time, and the uncertainties are so many, you might end up losing alpha against the market, because markets have been trending up. But there are periods where I have taken personally cash calls and have worked very well for me, because when obscene valuations are seen, or an asset class is extremely frothy, that's the time, you should take the cash call and move into some sort of, say, for example, if I'm investing into gold, equity, debt, and fixed income, and real estate. Now, if I see that, real estate is very expensive, and it is relative to the other asset classes, frothy, then I should take money out of real estate, right? And if I see equity is very frothy, at some point in time I should take money out of equity. So it has to be maybe once in a 5 year, once in 7 year phenomena. You should be in a position to have that flexibility to take the cash call, and that is something which we are contemplating, because we are managing only purely in ASK PMS. We are managing only equity money. Then it becomes tricky if at all we are taking an ad hoc call. But if it is based on certain framework, then we are more convinced on what we are doing, and then that is something which I have explained to the investment committee. And if we get that formalized, because it's a not my own decision, it's a joint decision of a team. And then if we are able to convince ourselves and make the investment committee and the board aware about it, then probably we'll institutionalize that.
Great, great. With that, we'll conclude the session here. Thank you so much for
Thank you.
giving us a detailed presentation and giving your perspective. It's always a pleasure listening to you. Lot of learnings. Let me just conclude this session here, and probably we'll catch up one on one. Thank you so much.
Thank you, Vikas, and nice
Thank you.
talking to you. And also
Nice.
to all your participants, extreme happy investing journey going ahead.
Right. Most of the investors who have logged in today are existing investors at ASK, and some of them are maybe in IP, or maybe one of them is in Vision and the growth and emerging also. Because those days we used to divide the portfolio 50 lakhs or 25 lakhs in IP and 25 in emerging. So they are there, and there was a feedback. So, basis the feedback, we decided to organize this session. Got to know, really happy to see the way things are now shaping up. You're revamping the whole thing, and maybe a little bit of tuning the investment committee's overall strategy may perhaps help us to create an additional alpha. So, on behalf of my team at Allport, I wish you best of luck. Thank you.
Thank you, Vikas. In a nutshell, what I want to say is, we have put all the, brains behind, what we need to do, and the structuring of because there was a need for restructuring the portfolios as well as an one-time a reset already has happened in all the portfolios. And you will see that what I explained is what, we are doing, and we are walking the talk. And I've done this before, right? When I took over ICICI PMS, exactly the same thing. PMS was in a bad shape, and we cared that it is not that bad shape, but ICICI, it was in a much more bad shape. And we took over the portfolio, and I was the head of PMS was asked to leave, and I took over the PMS, and eventually we became number one PMS in the country in the next 4 years. So
True.
I visualized a situation like that for ASK. We are going to have a fantastic experience for our clients over the next 3-4 years. Whatever experience today they might have in the last 3-4 years, maybe lagged effect, it might not have done well, so on and so forth. All the conversations will change in next 6 months, 9 months, 1 year. So that is my view. And
Right.
yeah, I am looking forward for those situations, because I remember from my 2010 to 15 period at ICICI, when I took over the PMS. Initially the situations were very bad, but eventually I got accurate mails from all the who's of the country who had investment. So I'm looking forward that similar kind of situation at ASK as well, and I am much more wiser compared to 2011. I would believe that at least 15 years hence, I'm or 14 years hence, I'm looking at the similar kind of situation, and we have put out the processes, principles in place well enough to capture the alpha. And mind you, the times are going to be not that easy for anyone to create alpha. And that is where the strength of a fund manager or the capability of the processes comes into play. And you will see that happening. So thank you so much for the time and opportunity. We'll happy to connect anytime.
All right. Thank you. Thanks. Okay. Bye.